Good evening, everybody, and welcome to the latest instalment of our financial education, our wellbeing webinars with Mattioli Woods. We're really grateful at Rugby League Cares for the continued support from Mattioli Woods, in particular Adrian Firth, who will compose this evening's webinar for us all. Again, it's so important, this area of our well-being that constitutes to our whole of person well-being. And the earlier that we can start to sort of integrate those skills into our everyday life, the far better we'll be, not only now but in the future. So I'm really pleased to hand over to Adrian in a moment. But just again, we're just so grateful for the continued support from Mattioli Woods and all the support that they give to our communities of people. So I'll hand over to Adrian. Thank you.
Thanks, Steve, and welcome along, everybody. Good evening to you. Really love working at this time of night and carrying on presenting for the day. But seriously, it's an absolute pleasure to be with you. Just to give you a little bit of background as to why we're here at Mattioli Woods, we do support Rugby League Cares because our organisation, our company, actually has some articles in its rules that say that we donate a proportion of our profits to support charities and third sector organizations. Rugby League Cares is one of those that we support. So because we're really successful, we give back to community projects and charities, and Rugby League Cares is just one of those because we like rugby. And it's just really good for me to be able to speak to you because I like rugby league as well. So it's pretty good. Well, listen, the reason why we deliver these sessions and deliver these webinars in the evenings is try to catch as many people as possible, but also because your financial well-being is a central part of your overall well-being. Now, if you sit back and think about it, your well-being is made up of lots of different areas, from your physical well-being, your mental well-being, your financial well-being, and some other areas as well, like social well-being and giving back to communities and things like that. But we know that if one of those areas isn't functioning properly, it affects all the other areas. So as an example, if you've got a physical ailment or an injury, well, you're much less likely to focus on your finances. You're very focused on getting back to full health. Similarly, if you've got a mental problem, money tends to be the last thing on your mind. But also, to flip that around, if you have issues with your finances, well, it also has a detrimental effect on your mental and physical well-being side of things. So actually keeping on top of your money and your finances is a really important part of your whole of person well-being. So that's why we deliver the webinars, and it's just an absolute pleasure for me to be with you again. And now we are taking a recording of the webinar, so don't worry, none of you are on camera or can be seen in any way. But just for the sake of the recording, I have to do the legal bits to start off with, which is that all the information is correct at the time of the recording taking place, and all my information relates to the 2024-25 tax year. Please don't panic. I'm not going to be talking about tax on the way through. Also, I really want to underline this important point that I'm not here to sell you or give you any financial advice in any way. We are just taking a very practical look at how we manage our money and our finances. This is an educational piece and nothing more. You can come through to us and ask us questions, and we will just answer them for you and help you with a little bit of guidance, but not financial advice. And again, we're not here to sell you anything. So over the next this is one of the shorter webinars. So over the next 35 minutes or so, we're going to just be taking a look at the topic of saving and investing. Now, I don't want any of you to be confused in any way by this, but saving has got absolutely nothing to do with investing. They are two completely different subjects. And hopefully on the way through, I can bring to life these two different subjects and show you how they are radically different from each other. And so in your mind, you shouldn't have saving and investing as the same topic. Quite the contrary, they are completely different. Now, normally on these webinars, we have a team of people, including Steve, who does the introduction, and colleagues in the background who answer questions. But I am on my own this evening because my backup has gone on holiday. So, nevertheless, you do have the opportunity to ask questions on the way through the webinar. On the right-hand side of your screen, you'll see a section with a heading at the top that says Q&A. click on Q&A and there's a text box underneath it. In that text box, if you want to ask a question, pop the question in there. Now, I can't answer them as I'm going along, but I will circle back and have a look in that Q&A section right at the end of the webinar. If there's anything there that needs to be picked up on and answered, then you rest assured I'll pick it up and I'll answer that question at the end. You will be anonymous, so if you do ask a question, nobody else can see the questions. It's just from you. But I'll anonymously pick them up and answer them, because if you've asked a question, the people watching the recording back at a later date will probably have similar questions in their mind. Also, if there's something I can't answer, I'll email you back, which very quickly brings me on to the use of your email addresses. We do not use them for marketing purposes. We don't pass them on to any third parties. We only use them for these webinars. And after we've finished, we delete them, scrap them, get rid of them. We will never use them ever again. So please feel free to pop any comments or questions in the Q&A tab, and I will circle back and have a look at them in the end. So the first topic on the list of two topics that we've got tonight is covering saving. And again, I just want to underline that's very different to investing. We're going to look at that later on. And really, with saving, there's a very famous quote. It's not attributed to any one individual, but it's been used by lots and lots of world leaders over time. And it goes that the art is not in making money, but in keeping money. And that's really pertinent to the start of this session, because it doesn't matter how much money you earn. What you've got to try and do is manage that money and make sure that you not only do all the things that you have to do with that money, like clothe yourself, feed yourself, keep a roof over your head, those kinds of things, but that money also goes towards some of the things that you need to do in the future. So we're going to look at the topic of saving to start off with. Now, if any of you fancy becoming a financial advisor after you've finished in the world of rugby, and all you've got to do is sit some qualifications. It's not particularly difficult. Most of them are multiple choice questions. But all you really need to do is for your clients is to sit down and talk to them and make sure that they've got a financial plan in place. Now, when you create a financial plan, you have three different areas of your financial planning. You've got your short-term financial plan, your medium-term financial plan, and your long-term financial plan. Now, long-term financial plans are really easy to talk about because essentially, when you're young, and this is a session for rookie players, so I assume that most people on the webinar are of a younger age. All you need to do is, when you're given the opportunity to join pension schemes, is to join them and stay in them and keep contributing into them. As a young person, that will give you a great start towards creating a long-term financial plan, something you can review as you go through your first career, second career, third career, but you've got to be in it to win it. So that's how and we're not talking about our long-term financial plans tonight. We've done a session on pensions. If you want to have a look at that, you can go through the player portal and watch that back. It was recorded a couple of months ago. I also can't do much to help you with your short-term financial plans because they're all pretty much set in stone. So you've got your Christmases, your birthdays, your holidays, and all the things that you want to achieve with the money over the next kind of 12 to 18 months. Well, those things are really not going to change, but we do have to be aware that we have those things coming up. And so setting aside a little bit of money towards those things is starting the savings journey. And that's what we're mostly going to be talking about. But when we come on to looking at things like investing a little bit later on in the webinar, well, that's really all around your medium-term goals. Because when we invest money, we need to put it somewhere where it's got time to grow, rather than just expecting to make an investment now and this time next year be a multimillionaire. That's not going to happen. So we'll come back and look at investing for our medium term a little bit later on. Long term's really easy. Join a pension scheme, stay in it. Short term, though, is money that we put into savings in order to meet our objectives of going on holiday, buying presents for people in the holiday season, all the things that we have coming up. And they all require money. You all know you've got them on the list of things to do over the coming months. So therefore, there's no excuse for not putting a little bit of money aside and getting into the habit of saving regularly. Now, you can't just blindly go away and open a savings account and put little bits of money in it here and there. You need to be in control of your finances before you know how much you can commit to regularly saving on a regular basis. In order to do that, it's nothing more complicated than sitting down in a basic form with a pencil and a piece of paper and writing down in one column the money you have coming in and writing down in another column all the money that you've got going out. Now, I appreciate a lot of people are very young. You might not have things like rents and mortgages and things like that. But if you are living at home with parents and going training and playing rugby, you do need to make sure that you're contributing a little bit towards paying rent. I mean, you are earning money and you are able to contribute. So start to put a bit of a budget together for things, clothing, food, rent, your accommodation, socializing, things like that. And once you're a couple of months into that, you'll start to be able to shape that budget to make sure that you can stick to it at the very least. There's no point in having a budget if you're just not going to stick to it. And can I remind you at this point, a few of you might be thinking, well, it seems a bit boring. I don't want to commit time to doing that. Listen, for ordinary people like myself, if we want to get fit, we commit time to going out running or commit time to going down to the gymnasium. If you want to have good mental well-being, you would take time out to have some peace and quiet and relaxation in order to do that, to contemplate things. Money is no different. You need to take some time out just to make sure that you've got the right things in place or the right tools in place to help you. And I promise you, having a budget will really help you in the long term. Let me just give you a quick example of why a budget's really important. Let's say, for instance, you decide, well, I'd quite like to, set up home and buy a home with my partner or my spouse. The first thing a mortgage underwriter is going to ask for is to see your budget. So you need to have one of these. It's a financial discipline that everyone should have, and keeping on top of the figures. Now, I've done a dummy budget here. It's not relevant to you all in any way, but I hope that there is money left when you've when you've set aside time to do a budget, and that money that you have left is there to help you meet your short-term and medium-term financial goals. So that's the bit you've got left over, which could help you achieve those objectives with your finances. Now, I'm going to take a bit of a break in the webinar. I'm going to pop a poll up on screen. You should have a question there now. And on the screen, it should ask you whether you've got an emergency fund. So if you could just let me know if you have got access to an emergency amount of money, or no, you don't have any savings that you can call on should something go wrong. I'm just going to pad for about 30 seconds because I have to sit and wait for all of the clicks on your screens to come through to me to let me know what the answer to the question is. Can I just say, while I'm waiting and pausing and waiting for some numbers to come through to me here, an emergency fund is not something like a credit card or an overdraft facility. That's borrowing. So that's something completely different. Emergency savings is money that you specifically set aside to look after yourself should you need to call on it. And I think I've wasted enough time. I do have some votes through, and everyone on the webinar has said that they do have an emergency fund. So thank you very much for taking the time to fill in the poll. I do appreciate it. Well, let me just take some time to underline why an emergency fund is really important. It's there for one reason only, and the name is on the tin, but it's there for emergencies. If your car breaks down, you've got enough money to get it fixed. If there's a bigger than expected bill, you've got some money there to do that. If your washing machine breaks down, you can afford to buy a new one if it's irreparable. There might be an emergency of some kind, and you've got to travel and be away from home for that emergency. It might be a family emergency or something. You have money there to pay your hotel bills and go and travel there and do it. So that's why we have an emergency fund. Now, if you go online and Google emergency funds, you'll get all sorts of different bits of information about how much should be in an emergency fund. I like to think of it as somewhere around 1 month's worth of money. So if you want to set the bar around there, There's lots of other things online that say 3 months worth of money, 6 months worth of money. That's probably going over the top. I guess the ultimate answer to the question is, why do you have an emergency fund? Well, it might be that if you lose your job or can't pay or have no income, then you have a period of time where you have enough money to make ends meet and pay your bills and carry on. But generally, I think of an emergency as, needing to do something on the spur of the moment, or being faced with an unexpected bill. And that usually is encompassed by about 1 month's worth of salary. So when we go back to our budget, we could see that we have money left over. If we committed to something like £100 a month or £50 a month, whatever it is that you're comfortable with, you are going to quickly build up a pot of cash, which you can call on should you need it. Now, I've got various different interest rates on this slide, 1%, 3%, 5%. I know at the moment that you can go out and get 5% on your money. But if we're talking about saving over a 5-year period, well, our mindset should be what's going to happen over the next 5 years. And there might not be 5% rates in 5 years' time. It might be back down to a level that we've seen for the last 10 years, which is about 1% or just below. So do bear that in mind. But obviously, opening a savings account and setting aside a little bit of money is a really important financial discipline to have, sitting alongside a budget. So you're always in control of the amount of money that you have. And if you are one of those people who gets through to the end of the month and you're thinking, well, why haven't I got any money left? Undertaking this exercise will really help you to achieve those goals. Now, when we're thinking about where to put our money, and this is cash in the bank, so this is just ordinary savings money that we're putting to one side, I really do think that you should consider opening an ISA or an individual savings account, as opposed to just having a normal bank or building society account to put the money into. Now, I've got no issues with normal bank or building society accounts, no problem whatsoever. However, we do have something in the UK called the savings interest allowance. Don't worry about the technical bit. But what it says is that after you earn a certain amount of interest, you have to pay tax on the interest that you're earning. And that's tax on money that you've already paid tax on when it went through the payroll and was paid into your bank account. So in order to avoid that, we use ISAs in the UK, and they're offered by all the major banks and building societies and lots of online financial institutions as well. And opening an ISA is a good idea, just purely because then none of the interest that you earn counts towards savings interest tax. So ISAs are fully tax-free, and any gains that you make on something like a stocks and shares ISA, don't worry, I'm going to come back and talk about that one a little bit later on when we look at investing. But any gains that you make are not subject to capital gains tax. Again, there are taxes on just about everything, but if you use ISAs, you will avoid any of those potential tax pitfalls. So ISAs have been around for years. They've been left unmolested by the current government. Nothing changed in the budget, which was wonderful for us. And that means that we can put up to £20,000 worth of money into ISAs every year. Now, if any of you on the webinar have partners or spouses, and you're a couple, and you feel very safe together in a good, strong relationship, well, you both have ISA allowances. So for a couple, you could put £40,000 a year into ISAs of various different types. Now, I don't want to confuse things in any way, but the easiest one to understand here is a cash ISA. That is your normal savings account with an ISA wrapping paper around it that makes sure it stays tax-free, and any money that's in there is tax-free. They are protected. They're underwritten. They're kind of guaranteed up to the value of £85,000 should anything happen to the bank or building society that you're putting the money with. So you should be safe in the knowledge that, small amounts of savings that we build up in ISAs are protected up to the value of 85,000. And at the moment in the marketplace, you should be getting a rate of around 5% on the money that you put into a cash ISA. which is an incredibly good news story because in our economy at the moment, we have high interest rates, and high interest rates equate to high rewards for saving cash. So do be aware it's a very good rate. We do also have stocks and shares ISAs. As I said, I'm going to come back and talk about that a little bit more later on, but those are investments. So when you put money or cash into a stocks and shares ISA, the cash is then invested in whatever you would like to invest in. And I'll come back and talk about investments a little bit later on. But I do want to mention here lifetime ISAs because they are incredibly popular and you earn a bonus on the money that you pay in. And the bonus is 25% of the value that you put into a lifetime ISA. You did hear me correctly. That's 25% uplift on the money that you put into a lifetime ISA. Now, you've got to be between the ages of 18 and under 40 in order to open a lifetime ISA. And really, the reason for you putting money into a LISA is to save up for a deposit for a house. Now, if you pay money into a lifetime ISA and you think, it's not for me, I just want to get my money back out, you're going to get back less than you've paid in. And I can guarantee that because you, first of all, receive a 25% uplift on the money that you've paid in. But then if you close it down and don't use it for buying a house, they claw back 25% of the full value, which would be considerably more than the 25% bonus that they uplifted you in the first place. So please be aware of that. You will get back less than you've paid in. However, as a vehicle for saving for a deposit for a house, they're absolutely fantastic. And if you think that it's per tax year, we could say do a lifetime ISA now in the run up to Christmas, and we could do another one after the 5th of April, just in a few months' time. And that would allow us to get £8,000 into a lifetime ISA. And that would be upgraded to £10,000 worth of money in the lifetime ISA, which is a fantastic bonus towards purchasing a house and having a deposit for the house purchase. Oh, also, what I should say is with a lifetime ISA, if you don't use it for the deposit for a house and you don't close it and have the money back, you can get it back later on in your life as like retirement income or later life income without any clawback back from it. But really, we should just use these if we're saving up for a deposit for a house. If you happen to be, as a couple are on the webinar, a little bit older like me, but we have children aged between 18 and 40, well, they can open lifetime ISAs and we as parents can help them by putting some money into them and they'll benefit from that bonus. They'll also benefit from putting money towards a deposit for a house. So again, very, very useful for a few different things. One of the key things that I want to underline with our money and with our finances, and just perhaps going into a little bit more detail about where we are in our economy and how well rewarded we are at the moment for saving money, is that we have a central bank called the Bank of England in the UK. Again, I don't want to confuse things, or I don't want to either speak down in any way, but in the whole of the United Kingdom, we have one central bank. That central bank, called the Bank of England, is responsible for setting rates. It's called a base rate. Now, they meet every 6 weeks or so and they drink tea and have bourbon biscuits and they decide how our economy is performing and what they can do to influence our economy. What we've had is high inflation. It was a result of a few different things: lockdowns, war in Eastern Europe, war in the Middle East, inflationary increases in the cost of goods and services. You'll know it as the cost of living, and you will have seen it in the news. But that sent inflation running quite high. Now, in order to rein that in, the Bank of England have increased rates, as you can see from the chart that you have on screen, but it's on a trajectory to slowly come back down, not come down anywhere near as sharply as it went up. I want to point that out. And again, I'm not giving you advice in any way as to what rates are going to do in the future. They could go back up. However, they have been very high and they are just starting to climb back down. Now, the current rate was set at 4.75, and I don't have an updated chart for you. I'm really sorry. The Bank of England are quite slow in updating their website, but it is taking steps to come back down. Why would you be interested in this in any way, and what am I going on about? Well, you should be interested because that benchmark of 4.75 sets the rates for saving and borrowing. So they are directly affecting you and your money. Now, as a saver, we want to get up to or close to the 4.75%. Actually, you can get just over it, over 5% at the moment. But if we're borrowing money, then we would borrow slightly higher than that at rates above 4.75%. So 5, 5.5, 6, etc. for borrowing money, particularly relevant to things like mortgages. So for borrowing, it's very expensive right now. But for saving, we haven't been rewarded like this for such a long time. Look at that chart there. It's been static below 1% for many, many years. And now all of a sudden it's leapt up to around 5%. So please be aware you will be well rewarded for putting money in the bank, setting aside a little bit of money, and saving a little bit towards your short term and medium term goals. It's never been a better time. And that feeds into me introducing the topic of cash versus investments. There's a sliding scale of risk with these kinds of things. Now, cash in the bank at 5%, there's no risk with it whatsoever. If you pay £10 in, you know you're going to get £10 back with a little bit of interest added on as well, we hope, in the meantime. If we were to take our £10 and go off and buy stocks and shares with it, well, they go up and down like a fiddler's elbow. So you may not get £10 back when you would put that in. There are various things in between. So there's a sliding scale of risk with what you do with your money. Now, the savings part of my webinar is no risk whatsoever. It's just opening a cash ISA. It's putting money into it on a regular basis. You know you're always going to get back what you've paid in, plus a reasonable rate of interest on the top as well. But there are other things you could invest in. And there's a sliding scale in how dangerous they are to your money or how productive they could be to your money as well. But with these steps that I have on this little chart here, I think goes with it the length of time that you could consider putting money into those things in order to see a reasonable rate of return. Property is very popular, and I'm aware of that with rugby league players in particular. Not only do they have a main residence, but they also like investing in second, third, fourth properties for rental incomes. It helps you to create a legacy, a financial legacy from your playing legacy as you're playing rugby league. Stocks and shares and things like that, they are seen as much higher risk again. So just remember there's a sliding scale on that. But we are interested in not just the short term and putting money to one side, but the medium term to long term financial plans as well. And kind of unique to rugby league is the fact that you will have one career and you will earn good money, I hope, during that first career. And then there's the desire to try and replicate that in your second career choices and third career, possibly third career choices as well. And what we want to have is some money to be able to comfortably transition away from playing rugby league at some point. You may still be involved in the game, but have a second or third career where we can try to replicate as much of that income as possible, but still make sure we can achieve all our financial goals. And I think for those medium term to long term objectives, it's all well and good holding cash in the bank right now because we're very well rewarded for it. But investing might suit some of that money because we can afford to put it away, leave it for a long period of time where we hope it might grow. And with investments, we are talking about leaving there for 5 years, 10 years, 15 years, 20 years, in order to maximize the possible growth that we could see from that money that we're investing. And again, I want to underline this really important point before I finish talking about saving and I start talking about investing. Right now, we're very well rewarded for putting money in the bank. UK inflation at August 24 was 3.1%. It then went down to about in September to about 2.3%. And in October, we've just seen the news headlines today that it's gone back up a little bit to about 2.5%. I know online you can go and get an easy savings access account or an ISA account for about 5% ish. I know I've got 5.2% on my slide. Just to bring home to you those facts and figures and numbers and tell you what they actually mean, it means we're very well rewarded for holding money. You're getting paid 5% interest on it, and the cost of living is going up by 2.5%. So, money that you're holding is improving ahead of the cost of living. So, again, never been a better time to save. And I would say to you to consider that very carefully before you think about investing, because we're very well rewarded for money that we hold at the moment. Nevertheless, let's think about what investing actually is. Investing is taking money and putting it into various different vehicles in the hope of beating just the rate of inflation and the interest rate that we could earn, which we've just covered on the previous slide. So your investments are going to have to perform above 5% to just beat holding money in the bank. Bear that in mind before you think about this. But investing is, at its most basic form, is buying a share in something. Now, think of all the biggest companies that you can think of off the top of your head. This is not an endorsement to buy these shares in any way, but I'm talking about companies like Apple, GlaxoSmithKline, the pharmaceutical giant, Vodafone, the people that supply mobile phone networks, all of those well-known brands, including water companies, utility providers, and loads and loads of other companies in between as well. They all have shares which you can buy. Now, they're not owned by any one individual. Those companies are owned by the people who have their shares. A share is part ownership in that company. So if you go out after today, buy any of those companies' shares, even if you just buy £100 worth of those shares, you own a part of those companies. If those companies do well and the industry sectors that they are in do well, then your share will go up in value. So therefore, you've made a profit and you can sell that share and have the money back if you want to. No problems whatsoever. But while you're holding that share, in order to give you the profits back, they give you a share of the profits as well. They're called dividends, and they're usually paid, twice a year for most major companies. And that's your reward for holding your ownership of that company. Now, if companies do well, you could make a lot of money out of owning those shares. If industry sector areas and markets that they're involved in do well, you could do very well indeed. But I want to underline the point that if they don't do well, or the market sector that they're in doesn't do well, or the global markets that they're a part of, like listed on the London Stock Exchange, if that goes down, we may well see some value wiped off the value of those shares as well. So those shares can also go down. But investing in its most simple form is finding a company that you're interested in, buying their shares, holding them for a period of time in the hope that over the coming years, those companies do very well and you make a profit by holding them. You can even buy, now widening this out, you can even buy investments that share the risk of the shares that you're buying. So you can invest in what's called a FTSE 100 tracker. Now, that is evenly spreading your money across the 100 biggest companies that are listed on the London stock market. And in there, you'll have your British Gas and your British Telecom and all the rest of them, the very biggest companies. And they'll spread that over those 100 companies. So you're owning those 100 companies, you're receiving the profits back from those 100 companies, but you're hoping that that index goes up. You can even buy things like gold, something sparkly for Christmas. You can invest in government bonds. You can invest in precious metals. You can invest in global markets. You can invest in technology. And what I would say is, if you are thinking of investing, is to decide what kind of an investor you'd like to be, because there are also ethical investments that you can make as well. Now, It's starting to get complicated, the world of investments, isn't it? Because there are literally hundreds of thousands of potential investments that we could make. So, where do you start? Well, first of all, you need to have a bit of confidence to hold on to your investments for the longer, medium term to long term, and stick to your financial goals. Now, when you see it in that way, that they've got a long period of time to improve the value, risk can be a good thing over that long period of time. And, you could carefully manage that risk to try to make sure that your money is working as hard for you as possible. And for that reason, we have things called funds. Now, the funds are groups of investments that all come together, and it's no surprise that they are managed by something called a fund manager. Now, fund managers put together funds for you to invest in based on what you're interested in. If you want to buy gold, I flippantly mentioned it before, but you can invest in a gold fund. And a fund manager will professionally manage that fund to make sure that your investment in gold does as well as it possibly can do. We expect that person, that manager in charge of the fund, to be adequately educated and be an expert in that particular area. And for that reason, they are regulated by the Financial Conduct Authority. Now, anybody who works in financial services and fund managers themselves are all regulated by the Financial Conduct Authority. So you should never invest in anything that isn't regulated by the FCA. You should make sure that they always are. Now, just to show you how easy it is to check things like that, you can go online right now. You can go to FCA and their website. On there is a list of all registered people that work in financial services. And if you go on there, I'm just going to give you a tip. I know I was introduced as Adrian Firth. Legally, my first name is Russell, but you can put in Adrian Firth and it will come up with a list of people with that name. There's only two of us. One of them is known as Russell Adrian Firth, and you'll see on there I'm registered, what I'm allowed to talk about, the things that I can, the areas of the industry that I'm allowed to work in. It's so simple to check things. It really is. And I want to make sure that you, if you want to invest, make sure that what you're putting your money into is regulated and is as safe as possible and is dealt with by educated individuals who know their areas and what they're talking about. So go on there, have a look, and make sure that everything is a regulated investment. That stops you being a victim of any kind of financial crime, and also that people are registered and fully listed there. When investing your money in something like a single stock or a single share, that's seen as quite a high risk investment because you're putting all your eggs in one basket. So if you just say, well, I'm just going to invest in Vodafone, that's great, fantastic. But what happens if something goes wrong with Vodafone? And for that reason, we then spread our risk by saying, okay, I'm going to invest in telecoms. And there'll be a fund there that's got telecoms as the main aim in there, and you're spreading your risk across that sector. But what happens if telecoms don't do well? Well, then we could spread the risk across something like, as I've mentioned before, the FTSE 100 companies in all sorts of different industry sectors. And so it goes on, and so it gets more and more complicated. I think the easiest thing for you to do is to go back to basics and think about what we call a stocks and shares ISA, which is there for investments. And when you open one, you'll be given a list of potential things that you could invest in. And there'll be hundreds of them. There really will. Don't be bamboozled by all of this. Go and have a look at them, and you'll very quickly be able to see how those investments are made up. And then you'll remember what I said about investing in an industry sector or a market sector, having a fund manager look after your money. The fund manager will take a charge for looking after your money because you're paying him for his educated knowledge of an industry sector. But literally, you can then pick things in a stocks and shares ISA that you're interested in. It might be gold, something sparkly for Christmas. It might be an environmental fund, which is investing in new energy types. It might be the NASDAQ in America, where you can track, technology stocks. There's all sorts of things for you to choose from. And I would say go on there, have a look at some of them. It will tell you whether it's low risk, medium risk, high risk. They usually tend to use words like cautious through to adventurous, but you'll get the way it works. And again, I want to underline that using an ISA to do it allows you to have protection should something go wrong with the financial institution that you're using, because it is guaranteed up to the value of 85,000 in just the same way that your cash was before it. So go on, have a look, do a little bit of research on the investment types that you're interested in. And as I've mentioned before, it's really your opportunity to decide what you'd like to invest in. You can invest in property through a stocks and shares ISA. There are things called real estate investment funds, which are investments in property. You can even invest in cash. People trade in cash. So you can, again, play the exchange rates and see if you could make money in that way. Overseas equities, stocks and shares, they're all listed there for you. And just very quickly to underline the fact that if you have any investment choices that are based on religious reasons, again, there are funds that meet those. And lastly, I would mention that if you're going to be an investor, just have a think about being an ethical investor as well. So maybe avoiding things like oil and gas and tobacco production and things like that, and erring on the greener funds which fund managers put together, which might seek to avoid those areas. However, having said that, they have made some very good profits over recent years. But again, I think if you're investing for the future. It's entirely up to you, but you might want a more ethical style of investment to suit your needs. Now, there are some dangers with investing, and I really want to point them out now for you before we finish. I'm not going to spend a lot of time on it, but if you go online and type in the words investments and things like that, you're just going to be hit with a load of people trying to sell you things. You'll probably get links to YouTube, which will show people day trading at home. They'll probably do like an hour's work in the morning, choosing their trades for the day, and they'll live in a mansion and drive a fancy sports car and have an airplane and live on an island and all those kinds of nice things. Can I just say, if something looks too good to be true, it is too good to be true. You are not going to make millions of pounds day trading. You are not going to buy cryptocurrency and be a multimillionaire this time next year. So we do need to prioritize where we're putting our money. Can I also just say that this is just some statistics from eToro, which is one of the UK's leading day trading and cryptocurrency platforms. 67% of trades that are placed on their platform lose money. And of people who open accounts with eToro, 70% of people that open accounts with them lose all of their money within 1 year. So if you think that you're just going to put it there and be super lucky, the statistics are that you're probably not just going to be super lucky. So please do avoid the allure of high returns, day trading, massive profits. It really isn't going to happen like that for the vast majority of people that use the platforms. And also, if you go down that line of inquiry, you're also, opening yourselves up to scams and frauds and fake investments and things like that. Did also want to just underline cryptocurrency here at this point as well, because a lot of people are interested in investing in crypto. Can I just remind you why cryptocurrency exists? And that's to facilitate illegal transactions around the globe. So you would use it for shopping on the dark web. You would also use it for money laundering, tax evasion, all of those kinds of things. That is one of the main reasons why cryptocurrency exists. So please do be aware of that before you put your money into them. And also, as investments, they are not underwritten by major UK institutions like government, like the Bank of England, like a currency and an economy backing them up. So they don't have any of those underlining safety nets built into them whatsoever. They're actually built on the blockchain. And if you do understand how the blockchain works, please pop me a note in the Q&A section so I know, because I don't fully understand how it is. But I believe it's based on something like mining and answering ridiculous questions to answers that are ridiculous. So yes, that's why they're there. Now, obviously, if you are entering into the world of investments, it is remiss of me not to say that you should get financial advice before you go off and buy investments. Hopefully, people can help you with that. If you want to find an advisor, well, there is a website called that actually, which is findanadvisor.org. You can go on there and find people either by location that are based near you or by recommendations based across the whole of the UK. You can go on the FCA's website as well, just to make sure that people are who they say they are and thus avoiding being a victim of any kind of financial fraud or crime. Again, you can find me on there. It's very easy to do. There are some other websites which are really interesting, like vouchedfor.co.uk, where people who have used a financial advisor and found it incredibly helpful will give those reviews and you can read about them. And they're one of the more honest review sites that's on the internet. So you can go on and have a look at that. I always talk about the moneysavingexpert.com website as well. Everything that I've spoken about on this webinar during this evening is covered on the moneysavingexpert.com website and more. So go on there, have a read, have a look. It's just really useful information. And again, if you're young and you're starting the savings journey, that's one of the main websites that you should use to get you up and running. They also got loads of information about putting budgets together and starting the savings journey and the importance of saving with high interest rates that we've got at the moment. So why wouldn't you? So I hope this has just been a really useful kind of 40-minute overview of the topic of saving and investing. Can I remind you what I said at the beginning? I don't want to bamboozle you or overdo things. I just want to find things that are of interest to you and give you pointers as to how you should approach managing your money and your finances. The key thing is that saving has got absolutely nothing to do with investments, other than both of them are there to look after either your short-term financial commitments or your medium-term financial planning. So saving for short term, investments for maybe medium term to long term. That's how we divide them up. And especially after today, if you have any questions or queries, and also if you're watching this recording back as well, then please don't hesitate to use my email to ask questions of me. I'm here to help. I go around the clubs. I do talk to players. I do talk to clubs all the time. The main aim is there's no selling, and I try not to use any jargon. I just want to give you the facts about having good financial well-being and having good control over your money and your finances. The overall point, if you take nothing else away from this, is that you should really have some kind of a financial legacy left over when you finish your playing legacy and finish playing rugby league. So I hope it's been useful. I've just had a quick look. There are no questions to answer. So I have escaped very, very well with this webinar. Thank you so much for joining us this evening. Again, any issues, please email me anytime. It's just a pleasure for us to help people who are associated with the world of rugby league. I do hope I'm going to have the chance to talk to you again at some point in the near future, and I hope I may see you during the season ahead as well. But for now, thank you for joining, and I hope you have a great evening. Bye for now.